last decade or so has been that the response of the Fed when they do decide that they're going to pivot, QE2, QE3, Operation Twist, et cetera, it drives moves in asset prices that are so asymmetrically out of proportion to the upside relative to what they're willing to tolerate on the downside, right? So this is one dynamic that I think is really has this strange trap property to it for the Fed, where they are willing to institute stimulus measures that drive asset prices higher by 50 to 100% over, a 15 to 24 month period. And then they react when markets drop by 15 to 20%, right? So you're correcting a small fraction of the damage that you did on the upside. But you're not allowing, the balloon just keeps, you've got this massive increase in the size of the balloon, you get a minor contraction, and then you get this massive asymmetric support again, right? The question for me is, can this dynamic go on forever? Can market PEs go, to maybe back to 2000 levels, or maybe to where we saw the Nikkei in 1989? Can cap rates on real estate go to, from 3% to 2% to 1%? I guess invoking Stein's law, which is if something can't go on forever, it'll stop, right? This type of dynamic seems to me to be unsustainable and is now an opportunity for the Fed to acknowledge these errors of the last 10 years and at least allow their balance sheet to run off, allow some of the air to come out of the asset bubble, keep rates low, and do what they can to kind of preserve economic growth so it sort of stumbles along still, right? Do you think that might be on the minds of some central bankers here?
Well, let me first address the first thing that I have, that you said about this whole thing, which I did notice this pattern a lot too. Yes, we get like 100% growth in stock market, and that's okay, and then 20% correction, that's panic. And one argument that can be made that overall economic growth, at least in the United States, is so fragile that it kind of relies on this continuously running stock market. And when a stock market, even flat stock market, is not good enough. And the more you get higher, the more like as a lot of debt and financialization and leverage in the economy grows. So like economy to grow has to grow that thing so fast that when you get like you can sustain small and small corrections without a hit to growth. Maybe possibly COVID let us get out, like delevered us a little bit and let us get out of this dynamic being so sensitive. But again, patterns tell us that corrections lead to growth slowdowns very often, right? But that is the first argument. And as a second argument, so sorry, your question was about, can you repeat this last portion of your question? Sorry.
Yeah, it was just, do you think that some central bankers are beginning to look at asset prices as actually a fundamental problem that needs to be addressed now because they've already kicked the can? There's been a series of policy errors that have now painted them into a corner. If they repeat this again, maybe they will never be able to escape from this corner without such dramatic repercussions that it would be so unpalatable for everybody.
Well, yeah, well, I'm sure they're asking those questions, first of all. And I just wanted to tie in, that's the reason I wanted to ask you to repeat. I wanted to tie in what I was saying before with what I'm saying now and make sure I didn't lose my thread. So you brought up earlier, like, where can PE go, right? What is sustainable and what is not? My problem with this is, and there's two warring ideas. One of them, when I talk about historical patterns, and historical patterns say that this is not sustainable, that, every once in a while, valuations run ahead, and people make an argument why this time that's sustainable, and you always end up buying stock market 70% cheaper if you are courageous enough. And I kind of believe that last year. I believe it now that we'll buy stock market most likely much cheaper than it is today, even in the next couple of years. That there will be a moment and you can buy it cheaper. I used to do those polls in 2018. I would like poll people and say, or 2017, like, raise your hands if you think in the next 5 years you can buy stock market cheaper than today. And almost everybody said yes. And I was like, why are you long, right? Why don't you wait till you buy it cheaper, right? So that was my position. It still happened to be kind of my position, but it is important to also understand that historical pattern is almost the only thing will have to guide us with respect to valuations. There is no rule what P should be. What is the P of gold? What is the P of Bitcoin? If we're starting to think of mega caps like Google's and Amazon's of the world as just a store of value, then as long as they're not, like if they were losing money, that would be unsustainable probably. But they can sustain it for a long time, but not forever. But if they're actually making a little bit of money and they're beginning to be dominant and the stock remains liquid, they could say like, Google stock better than treasuries, right? Let's just, who cares if they yield 1.5% when treasuries yield 50 cents, right? Why not? You can very easily make those arguments. What happened in 2000 when, this is my perception of the reality of 2000, then P's got out of control, valuations got out of control, and how did people arbit? They arbitrate by supply. People started to pour IPOs in the market, and they basically choked the money demand with IPOs. And they like, oh, I can just get 5 guys together or whatever, guys, women, whatever, and say, we're gonna start a company which has no business plan, but we're gonna do something and put .com, sell it for $100 million. Well, people start doing it till eventually the market get oversupplied. Now, is this the environment we're seeing right now? In some sense, not so much, because what happened between 2000 and now, we went to very much to this super winner-takes-all economy. So actually starting like a small search engine company is really not a very good business, right?